Welcome back. I'd like to spend a little time today taking a look at the fixed income market. Now, as the movement of stocks tends to reflect the expectation of future earnings, the fixed income market, specifically in this case, the US Treasury market, more accurately reflects the expectation of future macroeconomic forces, growth, inflation, the health of the US economy. So, focusing on the bottom left hand side, we see the yields of the US Treasuries. In particular, we have a 314 yield on the 30-year US Treasury bond. On the 20-year bond, we have a 3.35% yield, and these yields continue down to the 1 month maturities. Now, in particular, what we're looking at is an inverted bond yield, where we see a shorter term bond or a bond with a shorter term maturity has a higher yield than a longer term maturity. So in a normal economic condition, we tend to see the 30-year bond would have the highest yield, the 20-year bond would have the second highest yield, and so on down the maturity line. However, when there's the expectation of a future economic slowdown, we tend to see the longer-term bond yields contract and the shorter-term bond yields tend to rise. And we can see this also quite dramatically in the 2-year bond, or I'm sorry, the 3-year bond with the 323, the 2-year bond with a 322 yield, but then we go all the way out to the 10-year bond, it only has a 288. These inverted bond yields will tend to emerge among different maturities, but it's more important to recognize overall we do not have a smooth line moving up, meaning the longest term bond maturities don't have the highest yields. Now, on the top right hand side, we can see the divergence between the two. So, for example, while the 30-year bond has a 314 and the 20-year bond has a 335 yield, you subtract the 314 by the 335 and we see a negative 0.21% yield, meaning that we have an inverted bond yield, the 30 compared to the 20. Now, moving forward, we can see on the bottom left-hand side, the red line represents a total bond yields. The green line represents the spreads between the two. Now, the total bond yields is very simply all the different maturities added up. So the 314 on the 30-year plus a 335 on the 20-year, adding up all these yields gives us the red line. Now, if we were just to take a look at this red line over time, we'd say, hey, maturities are rising, or not maturities so much, but the yields of each maturity is rising. And that's, as a result of higher interest rates over the past few months. That looks like a healthy economy. But the fact of the matter is, it's not, reflected by the green line. The green line represents the spreads between each respective pair. So the 314, the 335, that's a negative 0.21% spread. The 335 to the 288, that's a positive spread. And then we take a look at the 280 to the 297. So we add up all those spreads, and that's reflected by the green line, and that actually shows us that the spreads are contracting. You see, in a normal economic, a healthy economic condition, the 30 would continue to move away from the 20, meaning that the 30-year yield would be continued to increase more than the 20-year yield. The 20-year yield would tend to increase more than the 10-year yield, and so on. However, in a contracting economy, although despite the fact that yields are rising, the spread between each respective pair of bonds is actually contracting. Now, in the top left-hand corner, the red line represents a total bond yields. Again, 314 plus 335 plus 288, etc. Compare that to the S&P 500. Now, recently we had late May, early June, or mid-June, I should say, a pullback in the S&P 500. However, bond yields continue to rise. In a normal economic condition, we tend to see bond yields rise along with stocks. However, if we see in the future the stock market turns to the downside and or bond yields tend to diverge and move to the downside, that could be a warning of future economic downturn. Now, bottom left-hand side, this is very interesting. We see correlations, relationships that exist between different bond yield spreads and the S&P 500. So, for example, the spread between the 30 and the 20-year bond and the S&P 500 going back over the past 10 periods, 10 trading days, there's about a 25% negative correlation. At one point, there was quite a strong correlation going back to early August between the 30-20-year spread and the S&P 500. That correlation has dissipated. However, around almost exactly the same period of time, a new correlation has emerged between the 20-10 spread, the spread between the yields of the 20 and 10-year maturity bonds. Taking a closer look at that, we can see here the purple line represents the spread between the 10 and 20-year maturities. The black line represents the S&P 500. And we can see as the S&P 500 moves higher, so does the spread between the 20 and the 10. However, we can see the former correlation that did exist between the 30 and the 20 really did fall apart. Stocks continue to trend higher. However, the 30-20 yield has dissipated. This is a result of the 20-year yield moving higher than the 30-year. And I think that this could really serve as a very helpful indicator moving forward. So we start to look to see, okay, there's a correlation between the 20 and the 30-20 spread. That fell apart. But for the time being, it looks like there's still a strong correlation, a strong relationship between the S&P 500 and the 2010. If that begins to dissipate and we start to see that the yields on the shorter term bonds really start to move a lot higher than the longer term bonds, the respective counterparties, such as, let's say, for example, we have the 323-year yield on the 3-year bond. If that starts to really fall apart and the shorter term bonds, like the 1 year, tend to overtake that, that could tell us that maybe more imminently an economic downturn could be in our future. At least that's what the numbers at this point suggest. But we're going to continue to watch these indicators very closely, and we'll be sure to come back with any updates in our fixed income markets. Hope this has been helpful. We'll see you again real soon.